Lucid Group, Inc. NASDAQ, LCID due diligence report date. September 8, 2025. Executive summary: Lucid is a luxury EV maker, Air sedan, Gravity SUV. Deliveries are rising, but company remains unprofitable. Backed by Saudi Arabia's public investment fund, approximately 58 to 60% stake. Big catalyst: $300 million Uber investment plus Neuro robo-taxi program, 20,000 vehicles committed. Reverse 1-4-10 stock split effective September 2, 2025. Volatile price action and mixed analyst sentiment. 1. Company overview and business model: builds premium EVs, Lucid Air, Gravity SUV. Revenue comes from vehicle sales, fleet deals, and potential robo-taxi program. Direct sales via Lucid Studios and online channels. 2. Industry and market position: EV. Industry is highly competitive. Tesla, Rivian, Mercedes EQ, legacy OE Miz, BYD. Lucid focuses on luxury, long-range, high-performance EVs, strong technology but weaker brand scale and awareness compared to larger peers. 3 revenue streams: vehicle sales, Air sedan, Gravity SUV. Fleet robo-taxi contracts, Uber Neuro. Aftermarket services still small. 4. Competitive advantages: strong range and efficiency engineering. Financial backing from PIF provides funding security. Uber Neuro deal offers future fleet demand. 5 scalability factories: Arizona, Casa Grande, and Saudi Arabia AMP-2. 2025 production target: 18,000 OK vehicles. Challenges: tariffs, supply chain, scaling costs. 6. Financial statement highlights: Q2 2025. Revenue $259.4 million. Deliveries 3,309 vehicles. Cash liquidity $4.8 billion, varies by definition in filings. Net income negative, loss-making. Cash flow negative, operating cash flow. Funded by equity convertible notes. 7. Valuation metrics September 2025. Market cap $5.6 billion. Enterprise value $5.5 to 5.6 BPE. Not meaningful negative earnings. Price sales approximately 7x based on 2024 revenue $808 MEV EBITDA. Not applicable, negative EBITDA 8. Growth potential and TAM. Luxury EV market is growing. TAM in hundreds of billions over next decade. Key drivers: Gravity SUV launch, mid-market model 2026, Uber Neuro fleet. 9. Competitor landscape, premium EV peers. Tesla Model SX, Rivian R1S, Mercedes EQ. Broader competitors: VW, GM, Ford, BYD. Lucid's strength: technology. Weakness: scale and distribution. 10. Management and governance. Interim CEO Mark Winterhoff, appointed 2025. Founder Peter Rawlinson, now strategic technical advisor. Board heavily influenced by PIF majority ownership. 11 risks: execution risk on production ramp, tariffs and input cost pressures, high cash burn and dilution risk, EV demand sensitive to interest rates, incentives, robotaxi execution risk, concentrated PIF ownership, geopolitical risk, 12 dividends, returns no dividends. Focused on growth and CAPE 13, insider and institutional activity, PIF owns approximately 58 to 60% of shares. Uber invested $30 in 2025, committing to 20,000 robotaxis. Other large institutional holders: Vanguard, BlackRock, 14, Technical Analysis and Market Signals, 1-4-10 reverse stock split, effective September 2, 2025. Stock remains highly volatile with sharp swings. Technical indicators mixed. Liquidity is still strong. 15. Analyst ratings and commentary: Morgan Stanley set $30 target September 2025, though consensus is far lower. Analysts are divided. Hold neutral majority with some sell ratings. Sentiment is cautious due to cash burn and production execution. 16. Investment outlook. Base case: moderate production ramp robotaxi begins 2026 to 2028. Break-even later this decade. Bear case: cash burn plus dilution, production shortfalls, EV demand weak. Bull case: Gravity SUV plus mid-market model succeed, robotaxi scales, margins improve. 17 key catalysts to watch: Q3 2025 delivery earnings update, NOV 2025, Uber Neuro Robotaxi Progress Pilot 2026, mid-market model development 2026 launch, any new capital raises or PIF funding moves. 18. Bottom line: Lucid remains a speculative, high-risk EV play. Its backing from PIF and the Uber Neuro deal offer upside optionality, but profitability and scale execution remain the biggest hurdles. Appropriate only for risk-tolerant investors willing to monitor production, margins, and capital needs closely.